Hello and welcome to World Insight, coming to you live from Beijing on CCTV News. I'm your host, Tian Wei. On today's program, a meeting of global economic leaders as World Bank and International Monetary Fund officials gather in Washington. China posts a better than expected growth rate. Is a rebound on the horizon? And mergers and acquisitions. Despite a sluggish economy, China's overseas M&A is set to hit a record this year. What's driving the boom? This week, the world's finance ministers and central bankers are gathered in Washington, D.C. for the spring meeting of the International Monetary Fund and the World Bank. Ahead of the meetings, the IMF released its latest World Economic Outlook, which has cut its global growth forecast for the fourth time in 12 months. Along with lowering economic growth forecasts for the most countries, IMF has raised its estimate rate for China. The IMF also warns that the persistent slow growth of global economy carries the risks of widespread stagnation.
Too slow for too long. Before its spring meetings along with the World Bank this week, the International Monetary Fund cut its forecast for the world economy for the fourth time in the past year. In its latest World Economy Outlook, IMF forecasts global economic growth of 3.2% in 2016 and 3.5% in 2017, dropping 0.2% and 0.1% points respectively from its January estimate. The 2016 forecast for advanced economies and emerging and developed economies has declined to 1.9% and 4.1% respectively. In the downward trend, the IMF has upgraded the growth forecast for China by 0.2% points for both this year and next, reaching 6.5% and 6.2% respectively. This rise is due to China's strong domestic demand and fast-growing service sector. Meanwhile, Beijing's efforts to transition China's economy towards sustainable growth are also praised in the outlook. Given China's important role in the global economy, its transition would impact much of the world. As a result of the disappointing global growth pace, which leaves the world economy more exposed to negative risks, the IMF calls for immediate action.
With its downside possibilities, the current diminished outlook calls for an immediate and proactive response. To repeat, there is no longer much room for error.
This year's World Economy Outlook suggests that advanced economies continue to make the most of their structural reforms, release supportive macroeconomic policies, and provide solid financial support. For emerging markets, promoting policy frameworks is advised to reduce their financial frangibility and build economic resilience. The IMF has long been criticized for not making a difference to the global economy. The IMF is facing pressure related to global terrorism, the refugee crisis, potential Brexit damage, and various geopolitical issues. Whether it can drag the world out of widespread economic stagnation remains to be seen.
For more on the IMF and World Bank spring meetings and the prospect of the global economic output, we are joined here in the Beijing studio, Professor Huo Deming from the National School of Development at Peking University. Welcome, Professor Huo. It's great to have you because today the Chinese Premier Li Keqiang was in your school. It's great that you have come all the way here and join us here. Also in Washington, D.C., we're having Mr. Paulo Mauro, who is a senior fellow at the Peterson Institute for International Economics. Welcome as well, Mr. Mauro. And in Brussels, we are joined by Mr. Daniel Gross, who is the director of the Center for European Policy Studies. Gentlemen, welcome to our program. First of all, mediocre, new mediocre, that is the phrase being used to describe the slow growth of the world economy. Mr. Mauro, what do you think are the main reasons? Do you agree with what IMF has been indicating? Briefly.
Well, we are now growing at a pace of about 3% in real terms per year in the world economy. That's not bad, actually. It has been revised down a little bit. It is certainly a pace of growth that is lower than we were used to prior to the global crisis. My personal view is that it's actually good that we have finally realized that we are in a new normal, and that perhaps we will view this as a perhaps slower but more sustainable pace of economic growth. Some countries are, of course, in trouble. We have a few emerging markets that are in outright recession, but the main advanced economies are actually recovering. The United States is growing at a very healthy pace. So there are some good pieces of news as well.
New normal is an interesting phrase. It's also picked up by American economists these days coming from China. And Mr. Gross, of course, the European economies, we've been talking about the Brexit. Of course, the IMF Managing Director, Ms. Lagarde, coming from Europe herself, has a big concern about that as well. And the European economies as a whole staggering. What do you make of your contribution from your parts of the world to the general growth?
Unfortunately, Europe is not really contributing to world growth. Maybe it's actually detracting a bit because the euro area, at least, it tries to lift its own growth via more exports. So I don't think you should look to Europe for a boost to the world global growth rate.
Professor Huo, here in Beijing, what about China's responsibility today? We heard from the president of the World Bank talking about the growth in the world. He mentioned about the United States as an example, good example of the developed economy, and India for the emerging one, but not China.
New normals, new mediocres, what's next? And I look at the world, I look around it. Well, we have, just like Mr. Gross said, well, don't expect too much from Europe. That's my interpretation. Right. But then what about the United States and China, which are the two sort of competing large economies in the world? I have put more bet on China, but China has its own problems. Maybe we should talk about it later. But in a sense that China's focus is different from the United States. And the divergence of these two, I don't see that World Bank and IMF, the reconciliation of these two. No, they're I don't know, the international institutions looks like they're doing something, but not in a coordinated way.
All right. Well, let me get some of the point you just talked about and throw it back to Mr. Maulo. Mr. Maulo, in the Peterson Institute, we know that there was a seminar earlier, and the Chinese vice governor of the central bank, Mr. Yi Gang, was there, talking to some of the American academics and also senior officials. He talked about China's growth rate about 6.5 to 7%. He also talked about China's economy in a way going quite well, at least in his interpretation. What do you make of it?
Well, let me say three things about China. The first one is that I think everybody agrees that there is an appropriate slowdown in the economic growth rate. And what I mean by that is that the economy is still growing extremely rapidly, but it is growing a little bit more slowly and gradually will slow down, partly because of the aging of the population. This is a natural process for the Chinese economy. The second point is that as China switches from the manufacturing sector to the services sector, which is something which is again natural and everybody agrees this is a good thing, as that happens, this is imparting a negative shock to the rest of the world. Why? Because the rest of the world exports goods to China. It doesn't export a whole lot of services to China. So while China's growth rate is relatively stable, maybe declining only a little bit, the rest of the world is suffering a little bit. This is a natural process, but it's something we need to be aware of. The third thing is that there are vulnerabilities in China. The fact that corporate debt is very high implies that we cannot push the growth rate beyond what it can support. So essentially, again, the slowdown is something that has to be accepted and accompanied by maybe very specific fiscal stimulus in a few areas. But certainly I wouldn't advocate a very big push, particularly not through excessive credit growth.
Mr. Maulo, I understand you have to go earlier than the other two gentlemen for another meeting, but before you go, I want to follow up with a few questions with you. What about the U.S. economy? There has been a lot of accusations from around the world as the U.S. economy is relying too much on its monetary policies. Even though it's doing quite well, also unemployment rate going down, but still, where is the fundamental support for the U.S. economic growth? Can it shoulder its responsibility as the biggest one in the world?
So my sense is that the U.S. economy is in a very good position right now. It's growing at about 2%. Frankly, since the IMF forecast has been published, some more data have come out on the first quarter of growth in the United States, and those were weaker than expected. So perhaps for this year, we'll see a couple of decimal points below 2%. We'll see. But you know, unemployment is low, inflationary pressures are rising, but still well below 2%.
Yeah.
So my sense is that the Fed will be able to raise interest rates a little bit this year, very gradually, just as expected. So on the whole, I think over a number of years, we'll see the monetary policy becoming less and less accommodative in the case of the U.S.
Mr. Gross, what do you think about the U.S. monetary policy? Too much in the weighing against all the other policies?
No, the U.S. is appropriately tightening slowly. I think the ECB is rather making a mistake by putting the foot on the accelerator and trying to do ever more, buying ever more government debt in Europe, while actually in Europe the situation is not too bad, because in Europe also the labor market is improving well, slowly, but it does. So I would say the ECB should also be thinking about the exit rather soon.
All right. Before we go, let you go, rather, Mr. Maulo, one other question. It is very important to have an American guest to talk about this, which is the quota of the IMF. The reform has been going on for some time, not much movement going on, not much action, a lot of advocacy. And now this time, the BRICS countries once again want to be united during the springtime meeting. They want to propose once again of the changing of the quota. Is the U.S. going to be active in that front?
Well, actually, the quota reform, the long-standing quota reform has been approved a few months ago, so that's on track. That was finally accepted by the U.S. Congress. The Chinese currency is now part of the SDR. So I think there's a lot of action that finally, after a long delay, has occurred. Of course, one starts immediately to think about the next round, because as the large emerging economies grow faster, think of China, but also think of India, then we will have to keep thinking about the new situation in the global economy, and international institutions have to reflect the sizes of the different economies. So that's a process that will go on for years.
It's great talking to you, Mr. Paulo Maulo from the Peterson Institute of Economics in the United States. But let me continue our discussion with you as well, Mr. Gross. What do you think of the IMF reform, particularly the emerging economies? European countries are pretty much reluctant to move.
The European countries have always been very reluctant to move, because some of the smaller countries, in principle, think that they can keep a seat on the board only by defending their outsized quotas, which stem from the 1960s or 70s, and also because sometimes they act as representatives of other countries. But I think that is an opposition which can be overcome.
What do you think, Mr. Professor here in Beijing? Is there going to be some real change this time, even though it has been finally approved by the U.S. Congress?
I'm reluctant of criticizing others, but let me say this. China is really learning its international role as emerging, also large countries. In a sense, China is willing to take up responsibilities from others if others are willing to So in a sense that I would like to see a new international orders which China's president has been proposing, and that really depends on United States and China. While Europeans, they can really be in a helpful ways of helping these two facilitating, but I don't see them as doing it in a proactive ways.
Well, the Europeans have a lot of their own problems to handle with, as you have already heard from Mr. Gross just a few seconds ago. But let me come back to you, Professor, because China's economy is extremely important here.
Oh, yes.
Yi Gang, the Vice Governor of Central Bank, today talked about China's market not necessarily representing or reflecting the real economic realities. Do you agree?
I saw the videos as well as the circumstances he was referring to. I don't really get what he means by that. Yes, if you are saying that China's financial sector too much money in there and
equity markets, probably that's what he meant.
Right, and to the real side of the economy, small medium enterprises that couldn't get loans, that is true. But I don't think he means that. So in a sense, China is slowing down, and the reason for slowing down is, well, different people have different views, but I'm looking at it is that China is the system which propagate this 10% growth rate, that stimulus was simply gone. And bureaucratic coordinations with the private market, and I think we are in a form of transition, and transit to a less government but still the bureaucratic system. They're stuck with, well, they don't know what to do because they're very used to very pro-business.
All right, and Mr. Yi Gang also talked about two other things. One is overreaction to the risks. He said is dangerous. You agree?
Overreaction means if the central government is overreacting, I would say for last year, there are certain circumstances, for instance, the August 11th exchange rate, probably a little bit overreaction, and sometimes the stock market back then. But generally speaking, I don't think the central government is really overreacting.
And the other thing is, you talk about the debts as well. Will that be a big problem for China? Because now China's enterprises, especially if China talk about decapacity, that is a big thing. Many of the enterprises will have to face once again their lifelong challenge, as they did back in the 1990s. During the last reform rounds of the state-owned enterprises, for example. And this time, will that become another problem?
Supply-side reform over capacity reductions in conjunction with high debt. Now, central government debt is not that high, but local government, as well as the SOEs of the local government, they're really a big problems. But my view is this: well, now we have a sort of debt transforming into equity that's been underway. And secondly, as long as that debt, local governments, so on and so forth, their debt do not explode so that systematic risk will happen the next day, China is perfect safe. So don't worry, it's on schedule.
Really? Don't worry, Mr. Gross?
I think it is right to say don't worry, there will be no big explosion. But I would say worry that there might be a very slow deflation, in the sense that every year the government has to prop up demand a little bit. Every year debt increases a little bit. And in the end, you might end up in a sort of Japanese trap. And I think that is the real danger, not so much a big explosion tomorrow.
I agree. With this kind of pace, that exactly what Mr. Gross referring to would happen, say, in 10 years, in year 2025.
But what about the growth rate? China, even though not necessarily looking at the growth rate, GDP as the barometer, but still the world is looking.
Our official stance is that for next 4 to 5 years, the growth rate has to be more than 6.5%. But the International Institute prediction is quite diverged. EIU of Economists magazine, they predict 4.3%.
Right. There are different kinds of hilarious numbers coming out at the same time.
I think those are, we need to discuss it more. That is really what my expertise, and I would like to see, I would like to ask how our government, the Chinese government, is able to keep at least 6.5% for 4 years.
Mr. Gross, before we go, also to you, a growth rate vis-a-vis the importance of reform. Once again, Mr. Yi Gang, the central bank, Vice Central Bank Governor, talked about without reform, or the reform too slow, that is also a big risk. Do you agree with that point?
No, I would say quick reform would be helpful. And I also think that quick reform should not look at what is the boost for the growth rate in the next quarter, but how can you put the economy on a more sustainable footing with much less debt. And I think that is the biggest reform of all, how to get growth going or keep growth going without having this explosion of debt which is ongoing, and that would be my main worry.
Well, it is all about restructuring the economy, isn't it? Whether it's in China or other emerging economies or developed ones as well. But it is certainly a very hard topic for any country to handle. We hope we'll have more solutions. But for now, I want to thank the two of you, gentlemen, for being with us. Daniel Gross, coming from Brussels, and Huo Deming here in Beijing. Gentlemen, have a great weekend. Thank you so much for being with us. Stay with us here on World Insight. We've got our final segment coming right up. Overseas mergers and acquisitions. Despite a faltering economy, China's overseas merger and acquisition is set to hit a record this year. Will that trend continue? Welcome back. You're watching World Insight on CCTV News. Despite a sluggish global economy, Chinese companies' appetite for investing overseas and diversifying their business has not been impaired, but rather encouraged. New data shows that Chinese companies continue to invest big in the overseas market for the first quarter of the year, accounting for almost 40% of the world's total.
China's overseas acquisitions are setting new records. Analysts say China was very aggressive in its overseas mergers and acquisitions from 2010 to 2015. And the latest Thomson Reuters data show that outbound cross-border merger and acquisition activity hit a record high of $101.1 billion in the first quarter of 2016. That nearly surpasses China's full-year record of $109.5 billion set last year. In February, the state-owned China National Chemical Corporation offered to buy Swiss pesticide and seed giant Syngenta for $43 billion, making it the largest overseas acquisition by a Chinese company. Home appliance powerhouse Haier paid almost $5.5 billion for General Electric's appliance business. Chinese aviation and shipping conglomerate HNA Group bought electronics distributor Ingram Micro for about $6 billion. Experts say Chinese private and state-owned companies are looking to acquire new technology and enter new markets in order to become stronger domestically and more internationally competitive. And the Ministry of Commerce said the Belt and Road Initiative was a major push for business cooperation between Chinese and foreign firms. Outbound direct investment to countries involved in the initiative was $3.59 billion, an increase of 40.2% year-on-year.
2015年中国企业所投资的
Based on our calculations, in 2015, businesses overseas invested by Chinese companies paid more than $19 billion in taxes to the host countries and employed more than 830,000 local employees.
Chinese companies' increasing cross-border investment is a byproduct of the country's economic transition. It is a trend that the central government welcomes and aims to facilitate.
And for more on the analysis of China's rapid overseas merger and acquisitions, I'm joined here in the Beijing studio by two guests. First of all, we have Charles Liu, founder of the Hao Capital. Welcome to our program. And also Professor Liu Baocheng from the Dean, he is the Dean of the Center for International Business Ethics from the University of International Business and Economics here in Beijing. Welcome, sir. And join us from Southampton inside the United Kingdom, we have Mr. Mike Bastin, Senior Lecturer at Southampton University. Welcome to the three of you, gentlemen. First of all, what do you make 40%? China's continue to contribute to the world's total merger and acquisition. Wow.
That's just the beginning. I think there's quite a bit more to come.
Yeah.
Because number one, I think what we saw in the last 4 or 5 years ago actually, were major state-owned companies. But now the private sector is aggressively pursuing asset purchases, technology purchases. And there's really quite a bit more to come because it's considered cheap.
Cheap in what way?
Well,
you mean
for
China
example,
has a lot of money to throw around?
No, for example, last year, I was involved in a transaction in which something was listed in New York NASDAQ. It's a chip company, semiconductor company. It was trading at about 12, 13 times PE. The same company in China would be trading at 30 times PE.
I
So
see.
there's quite a bit of valuation arbitrage. But also there are pieces of technology outside which can really benefit the Chinese companies.
What do you think, Professor Liu? Is it because the Chinese companies are too expensive, quote unquote, now internally, that going overseas might be a great idea, or some other reasons?
Well, I think number one is the pent-up drive, because if you see the Chinese import and export, we have been, the world number one for many years, and just simply because of the exchange rate, exchange control. So the many of those Chinese companies who have the wish to step overseas, and they are stopped, by domestic regulation in 2013, as late as that. So more of the private companies are allowed to have access to the foreign exchange, so that this
they get access to some fresh air. They want to exercise it.
I also agree with Charles. After the financial crisis, a lot of assets are devaluated. So China is now taking the chance.
China's chances vis-a-vis China's threat. What do you make of it?
Well, China's threat, actually, any sudden surge or sudden rise, when the economic presence over there, because made in China, through export, you only see the commodity, but now you see more of the Chinese, and also you see more of the Chinese capitalists sitting on the board of directors. So yes, there is a slight discomfort to begin with. But, with time, I think they get acquainted, and I talked with a number of...
Really?
Yeah, I talked with a number of the shareholders who participated in the Chinese investment in the mining industry in the U.S., and because the Chinese investor was one of my students. And they said, okay, we come to love this guy, and he's amusing, and not only...
Wow, maybe for them, but not necessarily for every story. Mr. Liu, for example, Syngenta story. China Chemical has been putting out huge amount of money over there in order to acquire this company, but according to the U.S. Congress, likely some of the representatives from the House representatives who are cautious about China's influence in the U.S. market might be there in the overall Treasury Department lead review of this case. Even though it is a Swiss company, it has a huge impact, or rather operation inside the United States. So if that part is not being approved, it could still be a problem for the original company itself.
Well, I think if we get into the subject, we'll have to get into the subject of the United States policy and U.S. government, because U.S. government is really not functionally looking at the benefit of global trade for the world. And
why would they? It's for the national interest, isn't it?
Absolutely, it's for their national interest. They benefited quite a bit from globalization. Some people lost out. But I think the issue here is playing politics. Politicians playing politics in the U.S. And that's why they're targeting China. It's always good to have an enemy to rally your troops around, and your CFIUS is looking just at Chinese deals. Now this particular deal you're talking about means potentially much tougher competition for U.S. companies in the same business. And that's something they would not like to see. And this
Very
is the
interesting.
protection.
Very interesting. This is one case study, which is hunting over there. We're still going to take a closer look as to how it's evolving. Another interesting example is one Chinese private insurance company, Taikang, rather, trying to go overseas and also acquire some of the international hotel chains, but not necessarily proceed with it. We see it. So what do you make of the dropping of the deal from the Chinese side of a private Anbang, rather? Sorry, I made a mistake of saying the name. Anbang, the insurance company, dropping the deal, and what would that mean for similar proposals from Chinese companies in the future?
Actually, through all the merger and acquisition, Chinese companies have lost a lot of down payments. You know, we try to seize the chance in the first place before we go for a careful strategy, and then we place a down payment, and then they say, okay, you know, forget this deal because, you know, we do not generate that much cash, or we do not rally so many investors together, or simply the government, you know, had a bone of contention with us. So this is also the case, and I think, well, that's the Chinese way of doing business. You know, we place a small bet to secure a chance, and then we exercise option, you know, to go forward or, you know, to drop out.
All right.
In our business, we call that breakup fees, and
That's
basically you have to, you know, as in a marriage, but it's a breakup fee. If you commit to proceed exclusively on negotiations, you have to put something down. But I think in this case, in the Anbang case, there was a major competitor. The Marriott Group was competing for the same Starwood set of assets. I think what we really have to do is to make a distinction between straight asset purchases and natural resources purchases, technology purchases, or acquisitions to gain market access. And all of these are really very, very different.
Which one do you think is the major trend now going on in China?
I think for the SOEs who've been burned badly on the natural resource purchases, given where commodity prices are today, they're more reluctant to move ahead in that sector. But increasingly, the small and medium-sized technology companies in the US and Europe are being targets and being aggressively pursued by the publicly listed private companies in China.
Right. We raised one case study of a private company, which is Anbang Insurance. We also raised an interesting case study of a state-owned enterprise, which is China Chemical. Both of them have their own stories of mergers and acquisitions. Of course, at this moment, the result is different so far. But for now, let me go to Professor Bastian. It's great to be connected with you, Professor. What do you make of all of these quite impressive cases recently in China? There are successful ones, there are pending ones, and there are still something that are not necessarily going to make everybody smile. So what do you make of all of these combinations?
Well, I think a lack of success is an inevitable feature of takeover, merger and acquisition, and it happens internationally. 6 out of 10 fail. So I think there's a learning process going on here. Those that have succeeded, I think there are psychological factors that haven't been mentioned so far that my research indicates are going on. That's where we see Chinese business managers far more confident, far more self-belief, and really scrutinizing takeovers far more carefully. And secondly, the important point, I think, generally is that these takeovers involve Chinese companies from a range of industries now. So this trend and the size of these is not a surprise. We see fashion, we see entertainment, we see Dalian Wonder buying Hollywood-based Legendary Entertainment, $3.5 billion, the famous toy shop in London, Hamleys, bought by Chinese footwear retailer C Banner. So I think this really will continue, and we'll see a range of industries in the private sector, possibly from the creative industries, contributing to this more and more, and it won't just be from energy, infrastructure and technology.
But we talk about all of these deals, of course impressive, the successful ones, but at the same time it's a huge amount of money, and many have been comparing what China is going through right now with 1980s in Japan, even acquired the Rockefeller Center, whether successful or not. But Mr. Liu, what do you make of that?
I think the circumstances are totally different. First of all, China still has some significant capital control, so it's another filter that the government can impose on investments abroad, not to go too crazy. But the circumstances at that time in Japan was really after the Plaza Accords, the yen became powerful and things looked cheap, like things look cheap now to the Chinese.
But you just said it's different.
It is very, very different, because at that time there was a sense of invincibility by major Japanese companies buying Monet paintings for $300 million, $400 million.
We have some private collectors also doing that from China at this moment, but it's private collectors rather than a company.
Exactly, and the companies at that time, I think, were giving unlimited credit lines by the banks. and the banks were pushing them to go out. But that's very different today. The banks are backing M&A action by Chinese companies, but they're also quite cautious. The ones I've been involved with, the banks really took some very hard negotiations to get
Professor
the
Liu, what do
leverage.
you think?
Well, you know, to counter his argument, I see some similarities. And, you know, we all have the syndrome that our eyes are bigger than our stomach. And suddenly we have cash and, you know, there's also blindfolded investment. So that's why, you know, roughly 50% of the merger and acquisition overseas fail. It's not only there, well, we continue to yes, we continue to blame the U.S. government, the CFIUS, who is really having political, you know, orientation. But mostly, it's a strategic move that is not really carefully calculated. And the other is that, you know, even after you successfully, you know, bought a company, the integration is a big issue. So cross-cultural communication with under one roof is the toughest one that is you know, you can possibly face.
Tell me more about that. I mean, not only that, cultural differences, but also what is the strategic goals that the Chinese companies have in mind in terms of acquiring and also merger? Let me go to you, Professor Bastian. If you look at the deal between Lenovo and IBM PC, one would applaud that deal. But at the same time, one would also question as to what is Lenovo have in mind in terms of the trend in a few years. As you may know, PC is not necessarily the big business these days anymore. So these are all interesting case studies. You could analyze from this aspect and also that aspect. What do you think of all of these quite mixed, shall we say, analysis, Professor Bastian?
I think that the goal of Chinese companies generally, I think, is pretty similar. They see international takeover of well-known brands as the best route for international expansion, and I don't think they're just looking in the short term and asset stripping. I think it's a very, very good way of building their company credibility, learning from these companies, and then building their own brands. And I think that's what Lenovo have done to a certain extent. I mean, they did pay a lot of money for IBM, but if they hadn't done that, would they be in the position they are now? So I think this spate of mergers and acquisitions isn't just a flash in the pan, and it isn't just about companies throwing cash away willy-nilly. I think they're really looking long-term and realize that those lucrative markets in the West can only be conquered long-term through initial takeover of established Western brands, and I think they're becoming far, far better at it. In your report, you talked about Hire's takeover, where they outbid and outmaneuvered Electrolux, for example, so they're becoming very professional at this, and really I think it's a very, very much long-term game that they're looking at now, which is very, very encouraging.
That is one form. The other form is almost like a Geely, which is quite interesting car manufacturer in China, looking at a very low-end market in China, in fact, but acquired the Volvo car. So how is that working? Is that an interesting sample for others to look at China's version of merger and acquisition? I was talking to Mr. Li Shufu earlier, just 1 month ago. He was telling me it's very different operation, Geely and also Volvo cars still at this moment, but he said that is the way to go. What do you think?
I think Geely, what it gotten from Volvo is far more than just a brand, because management style, R&D, design, there's so many things which would enrich Geely in China. And the real thing here, I think it's really, you got to separate by sectors. In addition to the cultural issues, you also have corporate governance, you have compliance, you have so many other factors which Chinese companies are not familiar with, which will take time. But in the financial sector, that's more difficult. Anbang, for example, insurance company, it's in the financial sector. So it would have to pay more attention to these things than manufacturing. Manufacturing, there are a lot of things which one can gain from the established brands.
Before we go, I still want to come back to the very first question that we talk about, which is political embargo and political barrier. We understand, Professor Liu, more Chinese companies are now doing this. How about we're not the majority holder? We're a significant minority holder of the shares. Will that work? Do you think that will work? Not only with private companies, Chinese ones going global and acquisition mergers overseas, and also state companies?
Yeah, I think in many cases this is really a smart move because before you have really the say the controlling share position, you need to know the company better. So by participating with small bet, taking a minority share, you are really getting commingled to with these people, and you learn the operation, not only the technology but rather also the corporate culture, so that you have the second step. To take a bigger share in a place. I think many more Chinese companies are doing that, like we are doing with the Club Med. Only 7% of the Club Med. I mean, only 7% of the equity. You're given a chance to learn and participate.
We only have 10 seconds left. Professor Bastian, do you think that will work?
Yes, and it's more evidence that Chinese companies are looking longer term, taking more care over their strategy and not rushing into things and perhaps making foolish capital investments that they may rue later. So a minority stake is very, very much a first step on the road to international expansion, yes.
And even more importantly, too, when you're not really familiar with the situation, you lower the risk substantially.
Well, there's so many fascinating case studies. Today we only will be able to touch on only a few of them, but many more stories to go and to come. Thank you so much, gentlemen, for being with us. Charles Liu, Liu Baocheng, both of you here in Beijing, and Mike Bastian from Southampton inside the UK. Thank you. Really appreciate it, gentlemen. Have a great weekend, all of the three of you. Thank you. And that is all the time we have for today. If you'd like to see more of a program, visit our website. Just type in World Insight CCTV News into your search engine. You'll be able to find us, or you can also check out our YouTube channel. From me, Tian Wei, and everyone at the World Insight team, thanks for watching, and tune in again next week for more insights from across China and around the world. Good night and have a great weekend.